Better to invest in growth investments for capital appreciation or dividend producing investments in retirement? I've got that and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Every investor has to decide how much offense they're going to play and how much defense they're going to play. Every investor makes that decision. Howard Marks said that, famous investor, and he's absolutely right. Whether you're in your 20s, your 40s, your 50s, your 80s, you've got to make that decision. And it's not like football where you say, okay, we've got the ball. I'm going to put these players out on the field. We've got the ball, therefore I'm going to, invest heavily in QQQ, and I'm going to invest in Apple stock, and we'll buy some NVIDIA, and we'll do call options and all that stuff. And then, oh, wait, nope, we lost the ball. We turned it over. Now it's time to put all those bonds out on the field. We're going to hold some cash and CDs. It doesn't work that way. It doesn't work that way. It's more like basketball or hockey, where you're going to put 5 players out on the field at any time, out on the field, oh my goodness, out on the court or on the ice. And when you've got the puck, you're playing offense, they're trying to score. And when you don't have the puck, you're playing defense, you're trying to keep the puck out of your net, right? And so that's the thing. You've got to decide what recipe of offense and defense you're going to play in your portfolio. Conventional thinking is, as you get to retirement, you need to be playing more defense. And I wouldn't argue with that overall idea. However, I would argue with the implementation of it. Oftentimes, many people just think, well, I'm at retirement, I'm going to start drawing off of these dollars. I can no longer have growth investments. I need to have safe investments. At the same time, see a lot of people that maybe aren't working with a financial advisor, or maybe they're just working with someone that sold them some investments, and maybe they slow down and temper the risk a little bit, but then they see that first recession, that first bear market in retirement, and say, I can't stay retired if my portfolio is going to drop this much. Move everything into low risk. And you never recover, and you never come back to it. So ultimately, finding the right strategy, which I'm going to share ours here in just a second, to navigate this decision of how much offense and how much defense do you play during retirement, it's a critical, very critical decision. So here's the question. Within that concoction, within that cocktail, do you have growth-oriented investments or dividend-oriented investments? First, growth is growth. Whether it's capital appreciation or so the company has kept those dollars, they've reinvested, and then hopefully the company's worth more in the future, or they pay a dividend, meaning the company has excess cash and they want to pay a dividend to its shareholders. Growth is growth. Okay, and just a quick example, going to one of the most famous investors ever, Warren Buffett, his Berkshire Hathaway, they've never paid a dividend because he said, I want my investors, I want my shareholders to see how much money that I've made for them. However, he is an unbelievable dividend investor. So, get that hyperbole here. He's never paid a dividend to his shareholders, and yet as an investor, he loves dividend-paying investments. Not exclusively, but loves. One of the most famous examples is his investment in Coca-Cola. They bought back in the 80s, I think, $1 billion worth of Coca-Cola. $1 billion. And now, every single year, they have over $700 million in dividends. Imagine that. You're almost getting all your money back every single year, plus you still hold the investment. Unbelievable. So growth is growth. So therefore, should you invest like Warren Buffett? Should you look more for dividend investments? And any one of us would love that Coca-Cola story to be our own. Well, listen, I would see more as dividend investing as a complement to your overall portfolio. It's going to be hard to justify, even though the dividend yield right now in the S&P 500 is low. It's going to be hard to say, well, it's not paying a high dividend. The S&P 500 isn't paying a high dividend. Therefore, you should abandon the S&P 500. No, even in retirement, I would still hold those growth type investments, but maybe consider, depending on your financial situation, your goals, your income strategy, complementing it with some dividend focused investments. So here's an idea, and this is sort of our approach for investing at retirement and in retirement successfully. It's modeled after what pensions do. taking a look through your overall comprehensive financial plan, specifically your retirement plan. All right, what are your income sources and how much money do you need in order to spend and have the lifestyle you want in retirement? Well, whatever that gap is, that's the amount that you need to draw out of your investments. If you can manufacture and structure an investment portfolio that meets your goals, meets your risk tolerance, and provides enough dividend income or whatever to fill in that gap, fantastic. That's an ideal scenario. Work with your CFP on that. Most people need to draw some principal out of their portfolio, a little bit more than that. They're not able to structure their entire portfolio just for dividends. They need a little bit more than that. Well, if that's the case, then doing that math to see, well, how much do I need to pull out each month or each year, most likely from my portfolio, and have 2 to 3 years worth of that in low risk investments, really short term. Not going to earn a lot of money, but won't have really any volatility, much at all. Those are your safe and steady dollars, because whether we see a recession, a big drop in the market, whatever, you want to make sure that you can still, that you're going to continue to receive your paycheck, right? Through, thick and thin, that you've got a stable amount of income. That's where that's going to come from, that confidence, okay? Second bucket is your intermediate term dollars. And these are often income oriented, and they're replenishing, that income is replenishing that first bucket. Typically so you might have some dividend investments in here as well, but oftentimes it's going to include a CD ladder, bond ladder, something else like that. So as that first bucket is being spent through, yeah, you've got some income that has dripped in to replenish, but you then are pulling dollars after those 3 or 4 years. You're pulling dollars from that middle bucket, that second bucket, into replenish bucket number 1. Then once you've got my 2 to 3 years worth of spending here in cash, another 5 to 7 years of spending here in an intermediate term bucket. Everything else that you don't need, that's invested for the long term. And I would consider complementing both growth with dividend in that long-term bucket. Here's an idea. Consider having 20% of your long-term bucket, of your long-term strategy, be invested in dividend-paying strategies, dividend-paying stocks, where you still will have some opportunity for appreciation, okay? But you're also getting a dividend yield that's 4 or 5%, something like that, double, maybe even triple the S&P 500, depending on the strategy. That's a way in retirement to level out, okay, the risk of market volatility at a time when you're drawing dollars out of your investments. So it minimizes the risk of you needing to sell more shares when the market's low, or draw out more shares when the market's low, okay? But also allows you to capitalize on dividend-paying investments, income-paying investments, to help replenish buckets number 2 and especially buckets number 1. So that's one strategy, that's one approach. As it comes to investing for growth or investing for dividends in retirement, I'd want a complement of both. And I'd want that strategy, that overall investment strategy, to fit within your comprehensive financial plan and your retirement plan. So work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well. Or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.